If you are over 50, there is a silent threat sitting inside your retirement account. For decades, the narrative was simple. You were told to play it safe, to move money into bonds, build a 60-40 portfolio, and protect what you built. But if you are 55 today and your planner tells you to stay the course, they are relying on math that struggled to survive 2022. Now look, I am not a financial advisor. I am not managing your portfolio. I am simply reading the history books that Wall Street seems to have conveniently forgotten. The old rule said when stocks crash, bonds go up. That was your safety net. But look at what is happening. That safety net, it snapped. Stocks and bonds are falling together. You might see the market rallying and think, the worst is behind us. You might be wrong. In exactly 4 minutes, I will show you a chart from 1976 that suggests the real wealth destruction has not even started. For 40 years, the system relied on a seesaw. Stocks down, bonds up. It was automatic. Bonds were your parachute. That parachute has been cut. For the first time in decades, the link that protected your wealth appears broken. The natural reaction? Panic. Sell everything, move to cash, wait for the storm to pass. That is the rookie mistake that can destroy fortunes. This is not just a crash. It is a trap with 3 walls closing in. Wall 1, the stock market drains your capital. Wall 2, bonds drop because rates are rising. Wall 3, you run to cash and inflation crushes you. With real inflation hovering around 5 or 7%, holding cash is like trying to hold water in your hands. Every month, you can buy less. You are not preserving wealth. You are financially bleeding out. Right now, there is no easy door marked exit. Look at this chart. The blue line is the inflation of the 1970s. The red line is us. They are not just similar. They are nearly identical. We are standing in the modern equivalent of 1976. Back then, inflation dropped from 12% to 5%. The government popped champagne. Newspapers declared victory. It wasn't a victory. It was the eye of the storm. 3 years later, in 1979, the second wave hit. It didn't just hurt, it devastated a generation of savers. It crushed the middle class. I don't have a crystal ball, but I have data, and the data warns that a second wave could be coming. Why is it potentially unavoidable? It isn't just oil prices. It isn't just supply chains. The reason is hidden in one number deep in the national debt, a number the White House is terrified to say out loud. In 1980, Paul Volcker became a legend because he did the unthinkable. To kill inflation, he raised rates to 20%. It was brutal. It caused a recession, but it worked. It saved the dollar. Why doesn't the Fed do it again? Why not raise rates to crush this new wave? Here is the math nobody in Washington wants to talk about. When Volcker pulled the trigger, U.S. national debt was small, 30% of GDP. The country could afford the payments. Today, debt is 122% of GDP. That difference changes everything. This isn't advice, just arithmetic. And the arithmetic is terrifying. If the Fed raised rates to 10% today, just half of what Volcker did, interest payments would eat up virtually every tax dollar collected by the IRS. The United States government would be technically bankrupt. The Fed knows this. They appear trapped. They cannot save the dollar without risking the economy. So they likely chose a third option, a quiet path. Economists call it financial repression. Here is the theory. Inflation isn't always a mistake. It isn't always an accident. It fits the historical playbook. If the government keeps inflation higher than bond rates, this allows them to burn away the real value of their debt. They pay back trillions, with dollars that are worth less every day. Who pays for this bailout? You do. The government has a massive liability called Social Security. If they admitted real inflation was 10%, they would have to raise checks by 10%. The system would arguably collapse. So the metrics change. The CPI formula is adjusted. The numbers might show 3% inflation, even when your grocery bill feels like it is up 20%. This gap between official numbers and your real life acts as a hidden tax on every dollar you saved. Where does this leave you? Here is the cold reality. The old buy and hold strategy is struggling. In an era of financial repression, long-term bonds can become a mathematical trap. If the government is inflating away its debt, and you hold paper assets, they are inflating away your retirement. History shows investors often turn to one shield: hard assets, things a central bank cannot print, and short duration, keeping money agile, not locked in 30-year contracts that lose value daily. I told you safety is the new risk. Now you see the math. In 1979, those who hoarded dollars lost purchasing power. Those who owned real resources survived. You do not have to blindly sponsor the government's debt write-off. You have a choice. If you want to understand the real math of money, not just the headlines, subscribe to this channel. The rules have changed. The only way to survive is to know the new game.